welcome to the magic of modern portfolio theory, optimizing your portfolio. My name is Brooke Hansen and I am the president of Creative Wealth Strategies. Over the next 20 minutes, we are going to describe to you a technique that has been around for about 100 years, modern portfolio theory, and our application of it, which is unique and exclusive to Workman Securities representatives. Because of the fact that I'm going to be talking about modern portfolio theory, which is primarily an equities-based strategy, everything in this presentation by its nature is not guaranteed, meaning we are going to invest in securities that go up and go down, so we're not guaranteeing a rate of return in this presentation. And that caveat sort of covers the entire nature of this broadcast. This presentation is delivered on a DVD. Through the magic of technology, we're going to have the ability for you to click through and actually look more closely at the graphics. So take a look at the menu of options that you have on the DVD after you're done with this presentation and see what parts of it you want to go back and look at some more. Every year, hundreds of millions of dollars are transferred into the stock market in the form of mutual funds or the separate accounts of variable annuity products. How is that money invested in the marketplace? Generally, people have four strategies. The first strategy is to stay out of the market altogether. The second is to buy and to hold. So you have the ability to buy something and hold it forever, which is a very tried and true method. People can use institutional money managers, or they can hire a portfolio manager, which of course is one of the options that we're going to give you today. Okay? Now, we all tend to know the risks of staying out of the market. I would comment that if you're someone who is willing to invest in real estate or create businesses of your own, arguably that is going to give you the best rate of return. More risky, to be sure, but it's a good strategy. But we know that if we're going to be invested without those active strategies, that we need to be in the marketplace. So if we're going to be in the marketplace, what technique are we going to use to manage our money? We're going to introduce you to the idea of modern portfolio theory. Now, modern portfolio theory was invented by a gentleman by the name of Harry Markowitz in 1950, and it was part of his master's thesis. And it was studied and studied over the next 40 years, and in 1990, Markowitz was given the Nobel Prize for economics for what is now called modern portfolio theory. A few years later, in 1993 and 1994, the law decided that they would change the long-standing prudent man theory. Now, the prudent man theory had been around for nearly a century, and it says that a prudent man, or it used to say, excuse me, that a prudent man would invest his money in treasuries, bonds, or at the bank, because they would be able to quantify or avoid the risk. Now, in 1993, 1994, the law came out and said what a prudent man would do is that they would get the highest possible return based on the risk that they were willing to take. How did they come up with this? Up until 1990, there was not a strategy that allowed you to balance your portfolio in such a way as to be certain to get the most return possible based on the risk that you were willing to take. Modern portfolio theory changed all that. And the law actually changed in 1994 to allow investors and trustees to invest in the equities markets. And as you saw in the previous slide, it's almost a necessity. I'm proud to say that a few years later, we used the prudent man theory coupled with modern portfolio theory to create two precedents in the state of Minnesota. Along the way, modern portfolio theory has been studied, and it has created certain truths that financial advisors use all the time to help explain risk versus return, etc. Now let's talk about what a couple of those truths are. One of the truths is that in excess of 90% of the results that you will receive in the marketplace come to you in the form of how your money is allocated. What does that mean? There's essentially 18 asset classes: large cap, small cap, growth, value, international bonds, etc. How your portfolio will ultimately perform is a constitution of how that money is allocated. You see by looking at this graphic that less than 5% of your overall result will come from the selection of your investment. In other words, if you bought the best stock out there, that is only going to account for 5% of your result. Now, at Creative Wealth Strategies, we focus on selection, meaning we try to buy things that are better than average. But we don't let it wag the dog. It represents only 5% of your return. You'll see that less than 2% of your return is based on timing. How are we supposed to guess which asset class is going to perform best in any given year? Obviously, 2% of your result is going to be an impact on that. And the balance of it is impacted by things called other. Clearly, we ignore other in our portfolio strategy. Another truth that Markowitz came up with was that different asset classes behave differently in the marketplace. I think people generally recognize this today. Large cap growth goes up differently than small cap value. In this graphic, it demonstrates the difference between simply value and growth styles of investing. And you'll see that they go up and down at different rates at different times. The concept is non-correlating assets. If you have certain assets going up and certain assets going down, those assets do not correlate. Makes sense today. But when Markowitz came up with it in 1950, it was a relatively new concept. And he used that strategy to create efficient portfolios. Now, as I mentioned before, what Markowitz says is that you can create a portfolio that is as efficient as it can possibly be based on the risk that you are willing to take. Now, Markowitz measures risk in the form of standard deviation. Standard deviation is by no means an economic strategy. It is a statistical analysis. It says this is how much something will be different than what we expect it to be. So risk is measured for our purposes in the form of standard deviation. If you look at this graphic, you'll see that you have the ability to create a portfolio that is on the efficient frontier. That curved line is the efficient frontier. Most of the time when we look at portfolios, they are inefficient. They are not built to be on the efficient frontier. If you are going to have the unbalanced portfolio, one of two things should happen. Either you should decide that that rate of return is good enough, and you should take less risk. And as you can see, you would be able to take substantially less risk to achieve that particular portfolio blend. Or conversely, you should decide that the amount of risk that you're willing to take is acceptable, but the rate of return that you're receiving is unacceptable, and you should change your blend to move up the curve to increase your return. As you can see in this example, which is more dramatic than it would probably be in real life, we can increase the results in a portfolio without modifying your risk. How do we do that? It is through the style of combining different risks. Remember that there are actually 18 asset classes, and at Creative Wealth Strategies, we tend to use 13 or 14 of them on a consistent basis. When we combine those styles, the fact that some things are going up and others are going down, we can reduce the overall volatility of the portfolio. And we do this by trying to harvest market fluctuations. Now, the next couple of slides are showing you a very simplified example of how this might happen. This slide indicates that we are buying two different kinds of stock. Let's call one value and one growth to be consistent with our example. We're buying the same amount of shares at the same price. So we have a beginning portfolio and it is equal. What happens? Now, the marketplace doesn't allow that to continue, right? And we know that. It changes every single day. In this rather extreme example, one went up 10% while the other went down 10%. Now, what would we do if we were trying to create a portfolio that was efficient? We would sell that portion of the portfolio that went up, that is high, and we would buy that portion of the portfolio that went down, which is low. It is essentially a mechanism of selling that which is high and buying that which is low. As you can see, we rebalanced the portfolio, or reallocated it, and what happened? The market flipped the other way. Now we have the stock that we sold, and when we sold it, we had to sell less shares of it than the shares that we purchased. That went down. And the other side of our portfolio, Portfolio B, which we had purchased shares inexpensively, bought low, went up. Now, this last slide illustrates that even though we had what looked to be negating market conditions, this is a flat market, right? We made a profit within that flat market. If we were to have bought and hold, we would have given up the gains that we had created in Portfolio A and given them back. And we would have lost the gains that we might have created in Portfolio B by riding with the tide. At Creative Wealth Strategies, we have certain tools that we use to build the overall infrastructure that we have to manage your assets. One of those tools is CDA Weisenberger. CDA Weisenberger consolidates all the information that's given to us from the mutual fund and variable annuity industry and delivers it to us in such a way that we can measure what that portfolio actually holds. Now, in this particular slide, we're showing you a portfolio that happens to be Marsico Capital Growth. Now, if you look at the slide, it indicates to you what asset classes this fund holds. If you look at the upper right-hand corner, you're going to see Growth Domestic. Interestingly, Marsico calls his fund a Growth Domestic Fund. And if you look at Morningstar, one of the other services, that's probably where that fund will show up if we were to use a style box. What is actually inside that portfolio, however, is what matters to me as the money manager, because I am simply trying to sell that which went up and buy that which went down. You're going to notice that this domestic growth fund has less than 1/3 of its assets in domestic growth. The other 2/3 of it are in something other than domestic growth, almost 1/4 of it being in the form of cash. Another one of the outputs that we use from CDA Weisenberger tells us how this portfolio has performed. You can see that this particular portfolio has performed pretty well over the last 5 years. It's difficult to say in comparison to what? To other growth domestic funds, and of course it doesn't hold a lot of domestic growth, but by and large the portfolio has performed well. We look primarily at what asset classes the portfolio holds, and then secondarily we look at how well that portfolio has performed over time. What you're looking at here is a perfectly blended portfolio. Now, it happens to be that this portfolio is what an institutional manager calls their balanced portfolio, which I'm going to talk about in a minute. But you can see that this is exactly on the efficient frontier. You also can see that there are a number of asset classes represented within this portfolio. Now, remember what we said before about non-correlating assets. Some of these assets are increasing in value by the nature of the marketplace. Others are decreasing in value by the nature of the marketplace. Plus, we know that people that manage these funds float around. They don't continue to own exactly what they own. The Marsico Growth Fund, by the time you see this, will probably own different assets than when we put it into the slide presentation. The pie expands and contracts on a regular basis. Our job at Creative Wealth Strategies is to sell the part which expanded and buy the part which contracted. It seems like a relatively simple process, and it is. It's just not easy because it requires a massive amount of input and an awful lot of due diligence to do correctly. Another piece of infrastructure that we utilize is a simple Excel spreadsheet. What you're looking at here is a fund holdings report. This fund holding report allows us to blend together a number of different mutual funds in a way to create a portfolio that we then match against the efficient frontier. And we continue to tweak this portfolio, plus or minus, until we get to a place where your portfolio is as efficient as we can make it based on the risk that you're willing to take. If you consider a buy and hold strategy, the buy and hold strategy allows you to float along in the marketplace. It is a reasonable strategy provided you actually do it. You buy and you hold. What people tend to do is something different. They let fear or greed or emotion get involved in their buy and hold strategy. But you'll notice that if you do use buy and hold, you may get the portfolio performance of the larger marketplace. You will not, however, have the opportunity to take advantage of market fluctuations. Most of the time, when people bring us portfolios that are in a buy and hold mode, they look more like this slide here, where our portfolio is no longer efficient from an efficient frontier perspective. Now, I want to point out to you that this happens to be an institutional portfolio that we looked at earlier. Remember in the previous slide where I said we have this institutional as advertised portfolio and it is perfectly allocated and perfectly balanced? This is what that portfolio actually holds. So this institutional manager, not that they were doing this on purpose, they're not evil people, but they used style boxes, they built a portfolio, and through time, through the nature of the fact that portfolio fund managers don't necessarily do what they say they're going to do, and the fact that the marketplace changes, the portfolio is no longer allocated, or if it ever was, efficiently from an efficient frontier perspective. It's an institutional model They spent a lot of time and energy creating it, but we can't hold it to any measurable standard because we don't really know how they're attempting to manage the portfolio. The other thing that the institutional managers don't do, and it's not because they're not trying to, but it's not part of their charter, is they're not maintaining your specific standard deviation. They can't be, because the portfolio isn't efficient to begin with, and it isn't being reallocated to your set of facts. Modern portfolio theory gives us the benefit of being measurable. It takes the emotion out of the game. We simply do that which we set out to do. Maintain your standard deviation and be as efficient as possible in how your portfolio is built. To summarize the benefits of using modern portfolio theory and the way that Creative Wealth Strategies implements it, using Markowitz's technique allows us to capture our gains in the marketplace. It allows us to buy shares at a relative discount because we sold high and we bought low. Most importantly, it causes us to maintain our standard deviation. By the nature of the technique, we keep our risk at a static point. And lastly, it creates a measurable and stable strategy that eliminates emotion and allows us to capture the most possible return based on the risk we're willing to take, considering that we are in an environment that is not guaranteed. The benefits of using Creative Wealth Strategies to implement modern portfolio theory. The fundamental reason is that we're true to the discipline. One cannot tweak modern portfolio theory. It's often in our industry that people are in competing situations to us where they'll say, well, we use a form of modern portfolio theory, but then we tweak it, we try to enhance it. I have to tell you that you cannot enhance modern portfolio theory. It is a statistical analysis of the marketplace, not one that tries to guess what the marketplace is going to do. Another reason that Creative Wealth Strategies does this well is because we've been doing it for a long time. We have a very small team of people. We've been managing portfolios for our own clientele since 1996. We do not need to charge an awful lot of money for this service, which means your representative can pass those savings along to you, and I'll let you to talk to them about the fee structure of this. But it is extremely competitive, and the biggest reason for it is we have a relatively simple infrastructure. We do not have an investor pool that we need to serve. We do not have an enormous staff that we need to feed. And we are already performing this for the benefit of our own clients. Take the time to talk to your representative to go one step further and see how modern portfolio theory can be implemented to benefit you and your family's future. Thanks again for your time.